Hi friends, today we are going to discuss about the financial market. As you know, there are different types of markets are there. People are going to market for buying and selling of goods and services. Both the buyers and sellers are present together to exchange the goods and services. That is called market. It is a place where the buyers and sellers meet together for exchange of goods and services. That is the traditional market as we know. But in concern to the financial market, the concept of the market is the same as the financial market, where the buyers and sellers meet for exchange of the financial assets, not the commodities, not the goods, but the financial assets. Why this financial market is required? When we are concerned, when we are concerning about the finance of the business, then certainly the market is also required for that. For the availability of the funds, for the transactions of the funds, demand, supply of the funds required by the business funds, supplied by the household savers, and there is some intermediation who are mobilizing the funds. So that is the requirement. So as we know that finance is the lifeblood of the business. Without finance, business cannot survive. So when business funds needs the money or the finance for the financial transactions, then at the time we think that where the business will arrange those funds. So that is the financial market is the place where the business firms can get the sufficient finance for the business transactions. So that financial market provide mobilize the savings of the funds of the general public into the business firms directly. So you can see this diagram. In this diagram, you can see that this is the financial market, this is the suppliers of funds, that is the households, who are the savers of the funds, they save the money, and this is the banks, that is the bank is the intermediaries through which the funds are where the savers are saving the funds, and banks sends those money to the business funds, who are the demanders of the funds. So that is the traditional way of mobilizing the savings. From households it comes to the bank, from bank it goes to the business funds. Whatever the return received by the bank from the business funds, they keep their own profit or the benefit, then the balance they distributed to the savers who are depositing the money in the bank. That is a traditional way of savings the funds by the public. So public are generally don't take the risk and also less return. Less risk, less return, because that is the side by side it goes on. So when you take the more risk, then certainly there is a more return will be there to your savings. The people generally think that we will save the money in the bank, and the bank gives us the returns and our money is safe, and there is a liquidity also. When there is will demand that bank, from the bank we will get the money. Yes, it is correct, no doubt. There is no problem or no doubt in it. Your money is safe. Your money is returned on demand by the banks, but return is less. Your money does not give you the good return, the higher return. So when the investors or the savers or the households expect the more return, then at that time they go for some other sources where there is more return is there, risk is also, the risk is associated there. So suppliers, what they are doing, they are searching some market where the money can be, or the financial assets can be used. Their investment can be done so that they can get good return, higher returns. So that is the service. The financial market is the service provider which provides you the service for the good return. As the bank provides, bank is just a safe custody of your money. The financial market is also the place where your money is to be used, put for the investment, and your money realize the good returns. So there, no intermediaries. From financial market directly money goes to the business firms. From business firms the return goes to the financial market. From financial market the households or the suppliers of the funds, the savers or the investors of the funds get direct return from the business firms. So that is from savers to the financial markets, from financial market to the demanders of the funds. The funds reach business firms, get the funds and then use their funds without any intermediations. The bank, earlier the bank put the intermediation when there is no financial market service provider is there. So bank provide the service to the business firms, to the household investors or the savers, and money is to be collected from the savers and channelized to the business firms. Whatever the benefit is realized, the bank gives their own benefit, profit, and they gives the less returns, the marginal return to the household savers or the people who saves their money in the bank. But here the same return which gives the bank to the bank by the business firms, that goes to the financial market, and through financial market it comes directly to the households, investors or the suppliers of the funds. So this is the way we can understand the importance of the financial market is there. So from this diagram it shows that these two functions is performed by the two major activities is performed by the financial markets. So that is the two activities that is performed by the financial market. First activity it is performed, that is the allocative functions. Allocative functions means the funds are to be allocated or the channelized of the savings of the suppliers from household suppliers to the financial market, and from financial market it is channelized, the allocated the funds to the business firms. The business firms get the money directly from the investors or the suppliers of the funds or the households without any intermediations. So this is the first activities performed by the financial market. The second activity is that is the financial intermediations. That financial market is just doing that financial intermediation. That is the financial service provided. The financial market provides the financial services to the households or the suppliers of funds. So that there are two types of investors you can classify. That one category is that the adventurous investors. Second category is that the traditional customers or the orthodox customers or the investors. The adventurous investors take the advantages of the risk as well as the higher returns. Higher risk is there, higher return is there. But the orthodox investors or the traditional investors don't want to take the more risk, they will get less returns. So that is the results of this. That is the financial market is just to make the intermediation, thus provide the service to the household investors or the small investors whose money is to be channelized to the demanders of the funds, reach to the business firms through their services only. That provides the good platform where your money is to be channelized directly to the business firms. That is the direct channelizations. So this shows that your money is reached directly to the demanders of the funds through financial market. Financial market does not charges any charges. They are not the custodian of your money. They are just give you as a platform where your money is to be goes to the business firms through that intermediation, financial intermediations. So that is the financial market which provide you the financial intermediations. Now next comes to the functions of financial markets, which is performed by the financial market for the suppliers of the funds, for the act as a intermediation, as well as channelize the allocate the finance to the business firms. So these are the various functions performed by the financial market. The first function is the financial market mobilize the savings. That means the suppliers of the funds are the investors or the households, savers. The small saving is to be done by the public in the different banks where their money is to be kept as a safe custodian of the bank and gives certain interest, which is very less. No risk is there, less interest. So the suppliers of funds thinks where they can channelize their savings to earn higher returns. So they take the financial market as the intermediation through which the service, through which they provide the investment to the business firms, and business gives direct return to the suppliers of the funds. So that is the direct return. This is return, this is investment. Investment, suppliers provide the investment to the business funds and business funds gives return to the directly to the suppliers. But it goes through financial intermediations. That is financial market. Financial market does these things. Just channelize. The savings of the public are come from their own pocket to the financial market for the investment in the business fund. That is the mobilization of the savings, mobilize the capital of the business fund to the business funds. Second is your price facilitations. Financial market fixes the price, determines the price of your investment, price of your return, the benefits. That means when suppliers gives the suppliers the money, financial assets to the business funds demands those money. The supply and the demand factors of the investors is the suppliers, demand is the factors is the business funds. The suppliers and the demands meet together to determine the price of the financial assets. So financial market determines the price for your investment, the return for your investment. That is the price. Then liquidity to your financial assets. That means whatever the money you had invested in the financial market through financial market in the business firms, the business firms gives you the assures, the financial market assures the liquidity to your financial assets, means investment. Whenever you demand, whenever you require, your money is to be again returned back to your hands. So that is liquidity. So liquidity is the convertibility into your cash forms which you had invested in the business firms through financial markets. Then last is it reduces the cost of your transactions. That means the transaction cost which involves the price of the transactions, that is reduced to less. When the investment is to be done in the bank and bank take the benefit of your money, you will get the benefit very less amount, and there your cost of the transaction is more. That means it costs dear to your transactions. Your bank is just sitting idle and just channelize your savings money and earn benefit, but the investors does not get anything. So this investors, when take the financial markets to invest money in the business firms, there the transaction cost of your transactions of your investment is less. That means more return is there, risk is there, more return is there, your transaction cost reduces. So this is about the financial functions, financial market functions. So financial market is the places which deals with the different types of transactions. Now we'll see. Let's see the classification of financial markets. So this is the classification of the financial market. So financial market is mainly classified into two broad categories. that is money market and capital market. Money market. Money market is two segments, that is the two financial market has two segments, money market and the capital market. Money market means the market which deals with the monetary transactions. Mostly it deals with the short-term securities, which the period is less than 1 year or less than 12 months or less than 365 days. Generally, it deals with the short-term securities, short-term bonds, which are to be required by the business firms for short-term period. Mostly, they need for the short-term finance purposes, working capital finance, day-to-day running of the business, bridge financing, the other requirements of the business transaction, emergency requirement of the business transactions. To meet of those funds, the money market supplies those services. So it deals with the short-term securities. The major participant, major players of the money market are banks, commercial banks, that is the nationalized or the private commercial banks, then RBI, Reserve Bank of India, state government, then financial institutions, mutual funds, business funds or the corporate houses. So these are the major participants, major players of the money market. Some are supplied the funds, some are the business firms or the demands of the funds. So that is the things. So the main features of the money market is there is a highly liquid of your assets or your investment. That short-term securities are there, highly liquidity and less risk is there. So when there is a less risk, obviously there is a less return associated with the less returns with the higher charges. They are charging more transaction cost and the less risk is there. Risk factor is associated with the business organization, business firms is very less. No risk at all, you can say. But highly liquid, that it means immediate demand, immediate you will get back your funds return. So that is the main features of the money market. Let's come to discuss about the detail, what are the instruments or the securities are dealt in money market. The first securities dealt in the money market, that is the treasury bills or shortly you can say the T-bills. It is the most common form of instrument used by the money market. The treasury bills are generally issued by the Reserve Bank of India on demand by the request by the banks. On demand request by the government, state governments, the treasury bills supplied by the Reserve Bank of India. It is a short-term source of financing. Whenever the state government is having shortage of money, shortage of funds, the RBI issues it. So in general, and RBI issues to the state government bank, that is called Treasury Bank, and Treasury Bank allocate, disburse the funds to the state government for their requirement. Whenever their requirement is filled up, and over they are having surplus of funds, the money is to be returned back. So that is a treasury bills. And sometimes the banks also provide the treasury bills to the business firms and the financial institutions issue the treasury bills to the business houses for on demand. So whenever they are fulfilled, that is to be returned back. And this treasury bill issued at a discount price, that is called zero coupon interest bonds or zero coupon bonds. That means the price interest is not charged, but the bills is to be issued less than the market price, less than the face values, and it is to be redeemed at face value. That means if the face value of the treasury bill is 100 rupees, then it is issued at 10% discount, means 9 rupees paid to the demanders of the funds. When their demand is fulfilled and they will return back the money to the concerned to the suppliers of the funds, they will return at the face value in 100 rupees. So that is the zero coupon interest bonds. Then commercial paper. It is a short-term promissory notes issued by the different firms, the business organizations to meet the bridge financing. So that is the commercial paper. So that is called bridge financing, short-term working capital finance. Its period is 15 days to 1 year, means up to 365 days, not more than that 365 days, 15 days to 1 year, not more than that. Yes, so this is the commercial paper. It is a provision note issued by the banks or the financial institutions to the business firms on demand for the short-term financing. When their financing is to be required is fulfilled, they will return back the money to the concerned suppliers of the firms. Then call money, or shortly we call money call at short notice. Call money is the money provided by the banks having surplus money to the demanders of the funds or the other banks who are having shortage of money. Just by giving a short notice, the money is to be collected and invested, and required fulfillment is to be done. And this is generally done 1 day to 15 days. This time period is 1 day to 15 day the limit, and it is to be provided at a high rate, at a particular rate of interest. The bank charges the rate of interest from the demanders of the funds, and when they are having surplus of funds, that money will be returned. So this is money call money, or the money call at short notice. Why it is call money? Because somebody will call at the rate, just like the auction, 1%, 2% call rate, and the demanders call the rate, and the suppliers supplies the money at the call rate. Call rate is the interest charged upon the money. So that is the call money call at short notice. Then fourth instrument is used in the money market, that is the certificate deposit. Certificate deposit is another source of finance that is to be provided to the business firms against their deposit of the certificates. That means they have to give the certificates about the deposit of the money, and against of that they will get the finance. So that the banks, the financial institutions provide those finance to the business houses, mutual fund organizations, LIC, UTI, GIC, etc. They also provide the finance to the business firms, business houses through the certificate of deposit. They keep the deposit certificates from the companies, from the corporate houses, and issue the loans or the issue the finance. So it is also within the 365 days or the less than 1 year. That is a short-term finance. Then lastly, there is the trade bill, or we call it is a commercial bill. Why it is called trade bill? Because it is for buying and selling of goods is used. Then we call it is a trade bill. So generally it is used. That is commonly it is called bills of exchange used by the debtors and the creditors. When the creditor supplies the goods on credit, the creditor is the drawer. He draws the bill upon the debtors who purchase the goods on credit. So creditor sold the goods, debtor purchase the goods on credit, and the creditor draws the bill upon the debtors, and the debtor accept the bills, return to the creditor. So that is called trade bills. So after the maturity, the bill is to be matured and the payment is to be done by the debtors to the creditor. So that is called trade bill. When this trade bill is used for the finance purposes, then we call it is a commercial bills. Means when this trade bill is to be used in the bank, deposited in the bank and discounted it and get the money for the business finance, business purposes, then we call it is a commercial bills. So this trade bill or the commercial bill is to be regulated under the Negotiable Instrument Act 1849, and this commercial bills or the trade bill is used or serves as a good source of finance, short-term finance for the business operations. Mostly the working capital finance, day-to-day operations, bridge financing, the immediate requirement, emergency need of the funds. For those funds, we need the trade bills or the commercial bills for the financing purposes. So its time limit is 3 months to 6 months, means 90 days to 180 days. That time limit is 90 days to 180 days. So there is a varies or depends upon the credit policy adopted by the business firms. So these are the money market instrument, that is a short-term securities, highly liquid, more risk, less risk, and more charges is to be done. So next come to the second segment, that is the capital market. Capital market, in other words, to the money market, capital market deals with the long-term securities. Means the securities which is more than 1 million, those securities are to be dealt in the capital market. So basically shares, equity shares, bonds, debentures, preference shares are traded in the capital markets. So it has two components, that is the primary markets and secondary markets. Primary market is called the new issue markets or the new issue securities markets. That means the market where business firms original issues of their securities, that is called primary market. That means the business firms, the major participants are, that is business firms, banks, financial institutions and mutual funds. So these are the various participants of the business funds, public, individual investors, etc. So these are the major participants of the primary capital markets. So in primary market, then when we called about the primary market, in primary market the business firms and the public or the individual investors are linked together for the buying and selling of the securities. When business firms newly issue the securities, the first time or the original securities are issued to the public at large or to the individuals or peoples at large, then we call it is the primary markets. There is a 4-5 different methods of the issue of securities, that is called methods of flotation of securities in the primary market. The first method is your offer to prospectus. That means the company make advertisement for the in the prospectus to issue the securities. The company offer the prospectus to the public or to the individual investors, suppliers at a large, and invite the public to invest money in the different securities, the equity shares or the preference shares or the bonds or the debentures. So this offer through prospectus is the best way to issue the securities. So after that prospectus is issued, public applied and for the shares, and the company allot the shares. That after allotment the shares are to be listed in the stock market for the tradings. So that is the offer through prospectus. Then offer for sale. It is offer for sale means it is offered to few particular investors. That is the offer for sale means it is offered to the few investors or the few peoples, that is the brokers or intermediaries. Here the company do not offer the shares directly to the public. Instead of that, they offer to the brokers or the intermediaries at a fixed price. The brokers, intermediaries purchase those shares, and after it listed in the stock market, they sell in the markets to the public. That is called offer for sales. Then third one is your private placement. Private placement means it is privately issued to the some of the investors, the individual investors or the banks or the financial institutions, selected banks, selected financial institutions, some large renowned individual investors, they are chosen and offer the total securities. That is called private placement. It is not for the public and it is meant for those people only. Then rights issue. When the company wants to keep their controls on their own hand, at that time they offer the private placement. Then fourth is your rights issue. rights issue is another method through which the securities are to be buying and holding takes place by the companies. That is, rights issue is only done for the existing shareholders. Those who are existing shareholder, old shareholders of the companies, to them company offer the securities or the shares, additional shares at a discount price, lower than the market price. So through that the company collects some money and invest in their business. So that is called rights issue, and it is taught for the all public. It is only for the public, but those who are existing shareholders. Then fifth one is your EIPOs. EIPOs means that is the electronically initial public offerings. That is called that through internet they offer the shares and securities to buy and sell. That is through initial public offering. Those are having electronically digital accounts, that is demat account, they can purchase and sell the securities from the companies. So that is called primary markets, and these are the methods of issue of securities. Next comes to the secondary market. Secondary market is the market where the new issue of securities are not purchased and sold. That is, old securities are buying and selling takes place. Old securities means the shares or the securities which are traded in the primary market, but the people are not get the chance to purchase the securities. Then certainly they enters into the secondary market for the buying of those securities. So here the primary market, the people those who are invest money, they are shareholders, they are selling the securities, and the new public are added through buying of those securities. That's why it is called secondary market. Secondary market is commonly known as stock exchange or the stock markets. So it is the market which determines of your buying and selling of securities. Through the demand and supply of the securities, the price is to be determined. That means the people's or the investors, those who are invested money in the primary market, they are the suppliers of those securities, and the people's the new publics are demands of those securities, and determines the price of the securities. So this price will determines for the buying and selling of the securities in the marketplace, and the price is to be determined, and this price is called stock price or the stock market prices. So this is the stock. Secondary market is commonly called the stock market or the stock exchange. So this stock market or stock exchange we will discuss in the next class. Hope you will understood this. This is the financial market, classification of financial markets. We discuss the functions of financial market, and the capital markets, money market, capital market, then money market instrument, capital markets types, primary market, secondary market, primary markets methods of issue of securities. So hope you have understood it. Thank you.